Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. We will be talking to Ted Oakley. He is the founder and partner of Oxbow Advisors. Ted, great to see you.
Thanks, Ivan, and thanks a lot.
Awesome. This week, the Fed says tapering of bond buying is coming soon. How did you read their statement? They seem to leave themselves a lot of wiggle room by using the word soon. Do you believe them, Ted?
Well, Ivan, we'll find out, I suppose, in November if they're serious, because if they started, November, December, 20 billion a month pulling back, then we'd be back at zero, in 6 months. But I think they would probably try to go through with it. I would give one caveat on that, is that if you have a market break of any kind, I can see them pull in and turn tail and run overnight. So that'd be one thing I would say would change that, but I'm not looking for that necessarily, but I do think that would change the landscape. But other than that, I think they'll probably try to get started.
Ted, that raises an interesting question, because a lot of people are assuming that just like the last time they tried to tighten, they gave up really quickly and turned right around. If that happens, let's say, just for hypothetical purposes, they came from 120 billion a month down to 100 billion a month, and the market has a fit, and they immediately quit and go back up to 120 or higher. Does the Fed lose all credibility in that scenario?
Well, I'll tell you, Jim, and I don't want you to take this the wrong way, but I don't think the Fed has a lot of credibility in it.
Our audience will agree with you on that one.
I've done this a long time, and the last Fed governor I really believed was Paul Volcker. And so I don't have, that side of it. Anything they did wouldn't surprise me. They've concentrated so much on the stock market, which is really not their job. But they concentrated so much on it that if it breaks, I could see them doing exactly what you said.
Yeah. So, we've got a couple of different variables in play right now. They've recently, earlier this month, most of the unemployment checks came to an end. The eviction moratorium came to an end. And now they want to add this tapering also. This is sort of like a triple whammy about to hit the economy. And affecting consumer spending. What do you view on this? Is this a little bit too much, all three of these things happening at the same time for the current state of the economy?
Jim, I would normally say yes. I think people forget to factor in, though, back in July 15th, we'd started the payments for children. And that offsets a little bit of that, because, if you have three children, you're in the neighborhood of, $800 to $900 a month after tax. And so that might help some of it for people with children, but it probably becomes a situation where we have to get more realistic. We're back in the real world again, so to speak. But that's what I would expect.
So are you surprised the markets haven't, crashed yet with all this, with everything going on? Are we just floating on a sea of Fed liquidity right now? What's holding the markets up at this point?
I think people have gotten used to bull markets. For our firm, we've been around longer, so we probably have a little different jaundiced view of it. But when you go this long without having a true bear market, I'm talking about 15 to 18 month bear market, then people get in a mode where they expect that nothing to worry about. If it were to fall off, we'll buy more of it, and it keeps on moving. I do think that's basically gotten you in the most speculative area that I've ever seen since I've been in the business. So at some point in time that will come home, but so far it hasn't.
Let's turn the conversation more to gold and silver. Are you surprised that they haven't responded to all the traditional, in the traditional way one would expect, with so much stimulus and so much inflation? Are you surprised that gold and silver have not been stronger at this point?
Well, we do own gold and a few of the miners too, and so I'm a little bit not surprised, because a lot of times gold goes with the bonds, and when the bonds started the rates started moving up. You'll notice this in the last 3 weeks or so. You had go, and I could see it again, maybe test one more time back at that 1700 level or just below it. But I do think in the long run, if you look at, if you go back and look at a Dow Jones to gold ratio or something like that, that it eventually becomes something that's really that'll do well in the next 3 to 5 years. And that's what we're looking at, more of a long-term play.
Any specific target that you have, or just more of a generic long-term positive view?
Oh, I would expect in the next 5 years that gold would go somewhere between 3,000 and 5,000. I would guess that'd be. I think you got up to 2,000, so it wouldn't be unusual for it to go to 3,000 to 4,000. So, but that's again, that's like a 5-year period. But we'll have to see how it comes out. But I don't. It's one of those things where I don't think you'll get hurt much on the downside, but I think there's a tremendous amount of upside if you want to look at it that way.
Ted, you've said in a prior interview, if you look at the last 10 years, it all has to do with the Federal Reserve. What did you mean by that, Ted?
Well, what they've done is they've created, and by the way, they've done this jointly the last time with the fiscal side. They've created a situation where when you put money out at no cost, basically, or zero cost, and you've got that much money in the system, and then people take on more speculation than they normally would. Mm-hmm. I mean, if you, it's been interesting for us to look at I'll just take the housing market. Why the Fed has continued to buy 40 billion of mortgage backs a month with housing exploding through the top is beyond reason to us. That's just one area. But what they did is they created all this ability to leverage. So you could leverage your public corporations, you could leverage high yield bonds, you could leverage private equity because you're paying so little for it. And when you did that, when you leverage those things, you created a situation where then that created more cash because people sell those things and then they go buy more things. And that's why you haven't had a break in anything. And they've gotten used to, hey, the Fed's going to take care of it. We've had, if you look in the last 10 years, every time you've had a little bitty market drop, 18 was, 40 days or something in last March. Here we come. And so I think people think, well, they're going to take care of us, but there will come a time when they can't control that. But that's been the problem the last 10 years, though, Ivan.
Yeah. A couple of weeks ago, maybe not that long ago, I think a week and a half, 2 weeks ago, we had the CPI print of 5.3%. What's your feeling on that? You think it's understating inflation? You think it's transitory, or you think it's headed higher with all the macro influences that are currently coming at us?
A couple of things on it, Jim. One of the things that happens is that I think there's other things that will kick in now that will keep the rate higher. There's a big war of words on here between the people who are looking for deflation and inflation. In a way, I think they'll both be right because if you inflate very much, you'll go back the other way. But what I do look to have, there's a couple of things going on and people need to realize this, but a lot of what they use in the CPI is what we call chain weighted, which means that, I'll just give you one quick example. If I'm buying beef and the price goes up a lot, they basically say, well, we're going to quit buying beef and buy more chicken. Well, that's basically a subjective move they make. Mm-hmm. So they can jiggle that a lot, more than you probably think they can. And the second thing is we haven't kicked in the rent side yet. That's a 6-month lag, and that's going to probably keep that inflation number up. I'm not saying it's 5, but look at it this way. Even if it's 3 for a long period of time, and you're only getting, even today, 140 on a 10-year bond, need to think about that.
To expand upon what you just said, the owner's equivalent rent portion of CPI, there's been a lot of talk about that, at least in our community, about how that's not a real accurate measure of shelter or rent, the way the CPI measures it. Is that, and everyone knows their own housing's been going crazy lately in terms of home prices, and rents are going through the roof. At least that's what all the private data has been indicating. And at the same time, CPI just includes this little tiny 0.01, 0.02 that bears no relation to the private data. So you think that's a big number that's still to trickle into CPI in the coming months?
I think it will for sure, because what happens is what they do on that is they use a 6-month average. And if you average the 6 months prior to September, before what you mentioned earlier about the rent situation, now it's back. So it'll take a few months because they do a 6-month average. And then I think you're going to see it gradually as you come in here.
Powell mentioned the Fed is looking into a digital currency in the meeting this week. Are we moving towards that one world digital dollar? Will anyone even trust it, basically?
Well, if you look at what SEC Chairman Gensler and also Powell and people have said, they think that private money, in other words, cryptocurrencies, will fail just like it did basically in the 1800s when everybody issued their own paper. Corporations, banks, they had their own money. None of it worked. But and I think what their point is that, hey, as a central government, we're not going to let you displace us from that. And so I think that's where they're headed with this, to say, tell you what, we'll have a digital currency, and and that digital currency, by the way, will be regulated by us. And so, I think that's where they're headed with it. I think the other side is they see China and what they've done already. Maybe they want to get in the midst of that, but it's probably coming. In a way, I hate to see it, because I think if you go all digital and no cash, I think that really puts them in a big brother situation, which I don't particularly like, but I think that could happen.
Yeah, a lot of people, that's why a lot of people are sort of opting out of the system into physical bullion, silver, gold coins, or, crypto. Some people feel that that's an alternative. Although, do you think if there is a central bank digital currency, whether it's a digital dollar or digital euro, do you think they would try to regulate out all the cryptos, viewing them as competition and, making the on-ramps and the off-ramps to that system more difficult?
I think, Jim, to a degree they would, but if you've noticed now, the SEC is they're going to require you as a money manager to let them know what you're doing with cryptos, and it's creeping in. You're going to see it where they track it now on the buy sells, and so that's coming. I think there'll still be cryptos, but if you look at 6,000 cryptos, our idea is that only a few of those really make it long term. I mean, seriously, make it long term. I'm not saying all of it's bad. I'm just saying, if you look to us, there's thousands of them that are not very good, and that's the point of speculation that's so tough. But yeah, they're gonna try to do that, but you have to realize now worldwide with the top 3 or 4, they're so entrenched. But they can give it a shot probably.
Onto the debt ceiling. That's the big news right now. Everyone's talking about. A lot of people, I'm one of them, think that it's a bunch of theater, and of course they're going to raise the debt ceiling, but they're all sort of holding their cards close to the vest and pretending like they're serious. What's your thought on the debt ceiling and this 3.5 trillion spending plan? Any thoughts on that?
Well, I know they're in this standoff because they're trying to get some things. I think they'll separate the two, really, because I've seen this before where there's, we don't have a debt ceiling, and after about 10 days of government employees and people not getting checks, they fold real quickly. So I think it's nothing more than grandstanding, and no matter what they say, they would never have the guts to do that.
To actually hold out for,
right. I think they will hold out on changing of the 3.5 trillion. There's so many things in it that are really not that great. So I do think that, but I think they'll separate the two and do the debt, maybe give a stopgap for a while until they get past it. But they don't have the guts to do that.
To actually shut it down, and go home. Yeah. Are you surprised the dollar has stayed so strong so long?
Well, I have been to a degree. I think that one of the problems is that coming through this whole COVID experience, you had to go with a currency you felt like it could survive it, and I think they look at us, vaccination and everything that goes with that, and our economy, et cetera, and they stay with the dollar. Now, having said that, in a few years, when they see this level of debt that's out there and that kind of thing, I think that if you'll notice, the dollar doesn't break out of this range right here. And I don't think it will. I really don't. But I think the next big move, I'm talking about 10%, will be down, but it may not happen for a year or two.
The other big topic lately is Evergrande in China. Evergrande. Sounds like something you'd buy at Starbucks, some sort of a latte. But what's the incentive for any U.S. investors to ever invest in a high yield junk debt in China ever again, if that's how they play out this type of scenario?
Well, I have to tell you, Jim, we always had a problem trying to figure out why they would do it in the beginning. You really don't control much in China. And they've shown that if they want to change something with a public company or anything like that, all they have to do is step in and take action. And so, and you're finished. I'm going to go, remember how wrong was the company that was the big bond trading company. They had these, 4 big funds, and that one basically went under, and they came in and recapped it and did some work on it and changed it. I don't think they'll recapitalize this one, but I do think they'll make sure that people who have bought real estate and are waiting to get that real estate, I think they'll support that through Evergrande. And then the balance of it, I think they'll just work through it. I don't think they really are too worried about the other holders as far as that goes. We'll see, but they have a tendency to do what they want to do. So I would guess that that'd be the last thing on their list.
Are you viewing this as just a Chinese localized issue, or there's still some risk that this affects others internationally?
Well, what they were trying to do, was they were trying to cool the housing market to a degree. But I don't think they want to. I don't think they're going to default completely and take Evergrande out because But that's what that was the initial response. What they wanted. That's why the housing's been slowing down there. I think it eventually will happen other places, not because of Evergrande, just because you get to a point with this parabolic move in pricing of homes and real estate everywhere, really, in Europe too, and to a point to where people say, hey, I'm just not going to pay that anymore. And that's what I think happens more so than the Evergrande effect.
I just want to say thank you, Ted. We really appreciate having you on Wall Street Silver.
Yeah, thank you very much, sir. We'd love to have you back in 2 or 3 months as the year develops and get your take on the market as all these things occur.
Thank you. Thank you very much.